Hi, welcome to the new video, the dividend relevance theory. It argues investors value dividends over future capital gains, reducing uncertainty and boosting stock prices. Bird in the hand. Investors prefer certain dividends today over certain future gains. Impact. Higher dividends reduce risk perception and increase stock value. Example, preference for a $1 dividend now rather than a $1.10 potential gain later. Support for dividend relevance. Empirical and behavioral evidence shows dividend influence stock prices and investor behavior. So, the relevance theory talks about there is a relationship between the dividend decisions and the company value. The empirical evidence shows dividends affect valuation model and stock pricing. Suppose if the company decides not to distribute the profit in the form of dividend, the shareholders will get dissatisfied. They will tend to sell their shares one by one. So demand for the particular company stock price will get reduced. So if the stock prices are getting reduced means the market value of the companies goes down. In overall, the company's value will go down. The dividend relevance theory, primarily associated with Myron Gordon and John Linter, argues that dividends do matter in determining a firm's value. According to this theory, investors prefer current dividend over future capital gain due to certainty and lower risk. Advantages of dividend relevance theory. It reduces uncertainty for investors. Dividend provide immediate returns which are more certain than future capital gains. This helps reduce perceived risk, especially for risk-averse investors. Signaling effect. Regular or increasing dividends are seen as a positive signal about companies' financial health and future prospects. This can boost investor confidence and stabilize share prices. Stable income stream. It retires and income-focused investors prefer stocks that pay consistent dividend, providing them with a predictable cash flow. Influence on share price. According to Gordon's model, dividend discount model, that is dividend discount model, a firm paying higher dividends could have a higher market value. This because the stock price is considered to be the present value of expected future dividend. Discipline in financial management. Regular dividend payment force companies to be more disciplined in capital allocations and investment decision, avoiding over retention of earnings. So these are all the dividend advantages of dividend relevance theory. Comparing these two theories. Theory treats dividends as a residual. Relevance theory treats dividends as a strategic decisions. Each has limitations. Perfect market assumption. Theory, perfect market assumption, dividends don't affect value, dividends are residual decision. Relevance theory accounts for market imperfection, dividends influence stock price, dividends are active decision. The real-world consideration. Tax policies and transaction cost impact dividend decisions. Dividend also help reduce agencies and information asymmetry issues. Variable taxes. Rates differ by country and income. Transaction cost. Dividend reinvestment plans reduces fees. Informations. Dividend convey credible firm signals. Agency cost. Dividend limits free cash flow misuse. Thank you.